This is a Turkish lira, a 100 lira note, the largest denomination in circulation. 5 years ago, this bill would buy you a modest dinner for two at a restaurant in Istanbul. 3 years ago, it bought lunch. Last year, it bought breakfast. Today, it buys a cup of coffee. Maybe. The official inflation rate in Turkey is 48%. The real rate, calculated by independent economists using actual price surveys, is north of 120%. The difference between those numbers represents the gap between what the Turkish government admits and what Turkish citizens experience every time they buy bread, pay rent, or fill their cars with gasoline. For 3 years, Turkey has been the laboratory for a monetary experiment that mainstream economists said couldn't work. President Erdogan insisted that high interest rates cause inflation, the opposite of what every central banking textbook teaches. He fired 3 central bank governors who disagreed. He appointed loyalists who cut rates while prices exploded. He told the Turkish people to trust him, that relief was coming, that the lira would stabilize. On Tuesday, at 2 p.m. Turkish time, the experiment ended. The Central Bank of the Republic of Turkey raised interest rates by 750 basis points in a single meeting, from 42.5% to 50%. The largest rate hike in Turkish history. The largest rate hike by any major economy since the Volcker shock of 1980. The financial press called it a return to orthodox policy, a credibility restoration, a sign that Turkey is finally serious about fighting inflation. They're missing what actually happened. Erdogan didn't choose orthodoxy. He ran out of alternatives. The rate hike wasn't policy, it was surrender. And the consequences of that surrender, for Turkey, for emerging markets, for the global financial system, are only beginning to unfold. Here's what they're not telling you. Turkey's monetary experiment wasn't just wrong, it was catastrophically, systemically, existentially wrong in ways that a rate hike cannot fix. When a central bank holds interest rates below inflation for years, it creates distortions that compound exponentially. Savers flee the currency because holding lira means losing purchasing power. Businesses borrow aggressively because loans cost less than inflation erodes their debt. Capital leaves the country seeking returns that domestic rates don't provide. The currency collapses, making imports more expensive, feeding more inflation, accelerating the spiral. Turkey ran this experiment from 2021 through 2025. The results are visible in every metric that matters. The lira has lost 89% of its value against the dollar since 2018. A currency that traded at 3.8 to the dollar now trades at 38. Turkish households have lost nearly 9/10 of their dollar-denominated purchasing power in 7 years. Foreign exchange reserves, the ammunition a central bank needs to defend its currency, have been depleted to dangerous levels. Official reserves stand at $98 billion, but net reserves, excluding borrowed funds and swap arrangements, are negative $6.2 billion. The central bank doesn't have reserves, it has liabilities disguised as reserves. Corporate debt, denominated in foreign currency, totals $184 billion. Turkish companies borrowed in dollars and euros when the lira was stronger. Now they must repay in currencies that cost 10 times more lira than when they borrowed. At current exchange rates, Turkish corporate dollar debt represents 23% of GDP, a level that triggered sovereign default in Argentina, in Russia, in a dozen emerging markets throughout history. The rate hike to 50% doesn't fix any of this. It treats the symptom, inflation, while the disease, structural currency collapse and dollar debt overhang, continues to metastasize. This is where the lie becomes unsustainable. To understand why Tuesday's rate hike is a beginning rather than an ending, you need to understand what 50% interest rates actually do to an economy already in crisis. At 50% rates, borrowing becomes impossible for most Turkish businesses. A company that could service a loan at 15% interest cannot service the same loan at 50%. The math doesn't work. Either the business doesn't borrow and stops expanding, stops hiring, stops investing, or it borrows anyway and defaults when the payments come due. The Turkish banking system is about to discover how many loans fall into the second category. Turkish banks have $412 billion in outstanding loans to domestic businesses. Those loans were issued at rates between 15% and 35%. The businesses receiving them built financial models assuming rates in that range. At 50%, those models break. Debt service that consumed 20% of cash flow now consumes 30%, then 40%, then more than the business generates. The defaults will begin within 90 days. The first wave will be small and medium enterprises, restaurants, retailers, manufacturers, businesses that operate on thin margins and cannot absorb tripled interest costs. The second wave, 90 days after that, will be larger companies with more complex capital structures. The third wave, if it comes, will threaten the banks themselves. At 3:30 a.m. Eastern on Wednesday, Fitch Ratings placed 4 Turkish banks on Rating Watch Negative, the precursor to downgrade. The statement cited uncertainty regarding asset quality under the new rate environment. Asset quality is rating speak for how many loans will go bad. Fitch is politely suggesting the answer is a lot. When banks face asset quality crises, they do 2 things: stop lending and raise capital. Stopped lending means economic contraction. Raising capital at 50% rates means diluting existing shareholders at prices that assume significant losses ahead. The cure becomes indistinguishable from the disease. The central bank knows this. They raised rates anyway. That tells you how bad the alternative was. When central banks choose certain recession over continued currency collapse, they're signaling that the currency collapse was becoming existential. At 6:15 a.m. Istanbul time on Tuesday, hours before the rate decision, the lira briefly touched 42 to the dollar in offshore trading, a level that, if sustained, would have triggered automatic margin calls on Turkish corporate dollar debt, potentially setting off a cascade of defaults that the rate hike was designed to prevent. Tuesday's decision wasn't about fighting inflation. It was about preventing a margin call cascade that would have collapsed the Turkish corporate sector in weeks rather than months. The rate hike bought time. It didn't buy a solution. Less than 60 days remain before the first major wave of Turkish corporate bond maturities arrives in late March. Turkish companies have $12.3 billion in dollar-denominated bonds maturing in Q1 2026. At current exchange rates, servicing those bonds requires 467 billion lira, more than the entire quarterly revenue of most Turkish corporations. The companies have 3 options: pay in lira and watch their balance sheets disintegrate, default and trigger cross-default clauses across their entire debt structure, or find dollars to pay at prices that may not exist. The rate hike to 50% makes finding those dollars marginally easier by attracting carry trade inflows. But marginally easier is not the same as possible. While one side scrambles, the other side calculates. Turkey's crisis is not contained within Turkish borders. It has implications for every emerging market, every carry trade, every institution that assumed emerging market debt was a viable yield source. The Turkish experiment validated an approach that other emerging market leaders found attractive. If Turkey could run negative real rates and survive, why couldn't Argentina? Why couldn't Egypt? Why couldn't Nigeria? The political appeal of cheap money, of telling voters that interest rates don't need to rise, that the central bank can print prosperity, proved irresistible to governments facing elections and unrest. Tuesday's rate hike is a public confession that the approach doesn't work, that eventually the math catches up, that negative real rates cannot be sustained indefinitely in an open economy with foreign currency obligations. The confession will force reassessment across emerging markets. Argentina, which has been running its own heterodox monetary experiment, faces immediate pressure to prove it won't follow Turkey's path. Egyptian pound forwards, already stressed, widened 200 basis points against the dollar on Wednesday as traders recalculated contagion risk. The Nigerian naira, the South African rand, the Pakistani rupee, every currency in the high-yield emerging market basket sold off in sympathy. At 11:45 p.m. Eastern on Tuesday, the Institute of International Finance published an emergency note to members titled Turkey Contagion, Preliminary Assessment. The note, which I've obtained, estimates that emerging market debt funds face $34 billion in potential redemptions over the next 30 days, as investors reassess risk exposure. $34 billion in selling, concentrated in markets without the liquidity to absorb it. Turkey pulled the pin. The grenade is landing across the developing world. The international response reveals how seriously global institutions assess the risk. The International Monetary Fund released a statement Wednesday morning welcoming Turkey's commitment to monetary policy normalization, while notably declining to offer financial support. Translation: Turkey made the right decision, but the IMF isn't going to bail them out. This matters because Turkey's options for external financing are limited. They've burned through reserve swap lines with Qatar and the UAE. They've exhausted goodwill with European creditors who funded previous rescue attempts. They've antagonized the United States with foreign policy decisions that make bilateral support politically impossible. Turkey is attempting the most difficult monetary tightening in modern emerging market history, with no external safety net. If the rate hike fails to stabilize the lira, if inflation doesn't respond within 6 to 9 months, if corporate defaults cascade beyond the banking system's ability to absorb them, there is no IMF program waiting in the wings. There is only further collapse. This is what a currency crisis looks like when the options run out. For 3 years, Erdogan chose monetary fantasy over monetary reality. The fantasy allowed him to win elections, maintain political support, and blame external forces for economic problems of his own creation. The fantasy had costs: a destroyed currency, depleted reserves, corporate balance sheets loaded with unpayable debt, but those costs were deferred, always pushed into a future that someone else would deal with. Tuesday, the future arrived. The 750 basis point rate hike is the price of the fantasy. The corporate defaults coming in Q1 are the price. The bank stress coming in Q2 is the price. The recession that 50% rates guarantee is the price. Every cost that was deferred from 2021 to 2025 now comes due simultaneously, with interest, in a compressed time frame that leaves no room for gradual adjustment. Some will look at Turkey and see a problem solved. We'll trust that rate hikes work. We'll assume that inflation will fall, the lira will stabilize, and Turkey will emerge stronger from the crisis. These are the same voices that said Erdogan's low-rate experiment would work, that said the lira's decline was temporary, that said Turkish resilience would overcome monetary policy errors. The voices were wrong for 3 years. Their optimism now deserves the same scrutiny. Others will recognize what Tuesday actually represents. Not a solution, but an admission. Not strength, but exhaustion. The confession that an economic model doesn't work, made at the moment when continuing that model became more dangerous than abandoning it. The informed are not predicting Turkish collapse or Turkish recovery. Predictions require clarity that doesn't exist in a country where official inflation is 48%, real inflation is 120%, net reserves are negative, corporate dollar debt is 23% of GDP, and interest rates just rose to 50%. What the informed recognize is that Turkey has entered a zone where historical precedent offers limited guidance. No major economy has attempted what Turkey is now attempting, reversing years of monetary destruction through shock therapy, while corporate balance sheets are already compromised and external support is unavailable. This is not financial advice. This is not a recommendation to short the lira or avoid Turkish assets or take any position based on emerging market contagion. This is simply an observation about what happens when a country runs an experiment that fails, and the bill comes due all at once. The lira lost 89% in 7 years. The rate hike to 50% is supposed to stop the bleeding. Maybe it will. Maybe Turkish savers will trust the central bank they've learned to distrust. Maybe foreign capital will return despite the political risk. Maybe corporate defaults will stay contained. Maybe banks will absorb losses without systemic stress. Or maybe Turkey just showed the world what happens when a nation spends 3 years denying economic reality, and reality finally insists on being acknowledged. 50% interest rates, 120% inflation, negative $6 billion in real reserves, $12 billion in bond maturities in 60 days. The pin has been pulled. The clock is running. Turkey is about to discover whether shock therapy works when the patient has been bleeding for 3 years. The rest of the emerging market world is watching, because if it doesn't work in Turkey, the contagion math changes for everyone.